as this conference is called CafeAlts, and Prem has deliberately given me a session on one of the most interesting topics called private credit, and that too post-lunch. Okay, so most people, when I talk to them, they said, private credit, okay, yeah, I will try to be there, right? So I thought this is the CafeAlts session. So let's have some coffee, some strong coffee coming in. Let's have some 4 brewmasters coming in who will give you a sense of what blend of coffee we are talking about. If equity is like espresso, strong, it keeps you awake. Sometimes jittery, it gives you the nerves. Traditional banking lending is like decaf, good, stable, a little bland. I believe that private credit is like filter coffee. Okay, no reference to my organization. It's like filter coffee. It's strong, it's robust, and it just kicks in at the right time when you want it to. The big question which is in front of my panelists today is, can we brew it right in India? There's a lot of enthusiasm around private credit. Can we brew it right in India? So I'm just going to start the ball rolling. Let's start by smelling the beans, if you will. I'm going to start with Archana. Okay, Archana, do you think that private credit has evolved from being a niche product, if you will, into a more mainstream product over the years? What's your view on that?
Great. So I think 7 to 8 years ago, private credit was more of a last mile, more expensive and transaction-specific product. Over time, and now I definitely believe it stands alongside bank funding. But just a few caveats to that. Just broadly, post ILFS, banks and mutual funds pulled back sharply from the segment. We saw that private credit had to step in with bespoke capital solutions. Initially, it was just to fill gaps, but eventually it led to real solutions that businesses needed. And having said that, if we have to measure mainstream by AUM, that might not be the right indicator. And we may miss the real story. So we have to see growing scale. The volumes in private credit that have has grown over the years, the number of managers increase in that since the last few years, and also potentially what we're seeing is that there's also diversification away from infrastructure and real estate. Private credit is now funding financial services, healthcare, consumer businesses, manufacturing. It's serving growth capital. We are serving working capital reasons. Businesses are coming to us for capex, acquisitions, and even green projects. So definitely, it's becoming more of a regular and repeat source of capital than a one-off trade, which promoters are learning to sort of build into their businesses than looking at it from a very transactional point of view. So definitely becoming a more clear choice of capital and has a lot of potential in this day and age.
Very interesting, and I believe you would also want to say that the removal of indexation benefits has also increased the scope of people trying to understand about more and more yield-hungry products, if you will, right? Okay. Nischal, you've got tremendous experience in terms of structuring. I would call it deep understanding of structuring and fixed income. Which sleeve or which sliver of private credit do you think is the most, which is the one is growing the fastest? Where is investor appetite coming in the fastest at this point of time in the private credit universe? Sorry, before that, if you could also talk about what sleeves, what are the different types. She did mention, but it will be nice to hear from you as well.
So obviously we are in performing credit strategy, and at least we see a lot of traction, a lot of interest, investor interest in our category of, despite having like so many funds now compared to what it was say 7-8 years back when we started, right? So still there is so much of interest in investing in all of these funds. So that way we see a lot of traction here.
So what do you think is the fastest growing segment? I keep hearing about real estate credit, I keep hearing about performing credit. Somebody told me that performing credit is the vanilla ice cream of private credit. Everybody wants to have a piece of it. And then somebody saying venture debt. What is your view? Just a unilateral view. What do you think is the fastest growing segment right now?
I would say performing, but again performing, there is a label, right? Performing is a very used word, right? So there are funds who would be very true to the label, there are funds who would maybe go a bit here and there, but by and large that's a strategy which I see a lot of investor interest, at least the local interest.
Very good. So we're talking about it going mainstream, almost all segments of performing credit doing well. It's a generic term like you rightly pointed out. Well, Ritesh, you talk to the customer the most, right? You talk to HNIs, you sit on the same side of the fence, HNIs, family offices. And earlier during one of the conversations, I think Monish was talking about the conversations being primarily around real estate in the initial days. Do you think that more and more HNIs and family offices are not just talking but increasing their incremental allocation to private credit?
So I think asset allocation is the first stage, right? And within asset allocation, family offices look at equity, fixed income and real assets. Typically, their allocation will depend on various, things. It would be dependent on what their goals, objectives are, where they see the markets. Market sentiment can, change the allocation, or it could be liquidity, whether short term, long term, at the stage of evolution, etc., etc. So first stage is obviously fixed income. How much allocation they want to, do to which asset class. Private credit is gaining traction within the fixed income allocation, right? So wherever there is typically family offices look at about between 20 to 30% of their allocation to fixed income, and I think private credit is forming a core part of the fixed income allocation, going forward. Again, this is led largely by the fact that the debt returns are low. I mean, given the way where the interest rates are. Second is a tax, thing which you spoke about, where the between debt mutual funds and private credit, there is no differential anymore. And third is the fact that equity valuations are there where there are, and there are concerns about what returns equity market will give going forward. That is what is generating this additional interest in private or credit neutral strategies, where returns are not linked to equity. You still can generate a double-digit return, which is basically beating inflation, and you have some kind of a downside protection. So yes, private credit currently for family offices profile could be between 5 to 6% of their overall allocation, but I think given the large institutional players are entering this segment, like HDFC has launched a private credit fund, ICICI is launched. So I think that is giving more and more confidence to people to kind of look and evaluate some of these strategies.
Super. You did mention the word yield 4 times in your point, and I guess the best person to talk about yield has just come in. Ashish, welcome. Glad you could make it. I think we need to allocate a little bit more money to infra financing to improve the traffic. But glad you could make it on time. And I'm just going to ask you point blank. A lot of people think about private credit in India as a high yield opportunity. I think that is what you were also alluding to, Ritesh. Where do you draw the line between attractive risk-adjusted returns and overreach?
Sure. So from a fund manager's perspective, our job is to price the risk appropriately. So there are various risks. There could be liquidity premium that you have to price in. There could be closeness to the cash flow. In a lot of private credit structure, you may not be as close to the cash flow. So that commands a premium. So from a fund manager's perspective, you take into account the various risks and the premium that you need to allocate towards that. And from an investor's perspective, the alignment has to be there, what to expect out of a product. For instance, if you are looking for a regular cash flow, some of the special situation or distress fund would not be the appropriate choice, because there you need a lot more patient capital, turnaround situations, which may not be cash flow generative. So the expectations have to be right, and people need to understand risk classification of each of the, within private credit there would be various segments. So investors need to evaluate what risk suits them. Someone might be okay with a completely back-ended cash inflows and taking a patient call. A lot of structures do happen, especially in the turnaround situations, where a lot of cash flows is back-ended and the turnaround itself may take a lot of time. So the alignment has to be there. There is a space for every strategy in this private credit space. So one needs to just be aligned and keep the expectation right in terms of what to expect from a particular segment of the private credit.
That's very interesting, Ashish. We started by talking about coffee. So either, when you're making coffee, a barista will tell you that you have to have the right sort of blend or the right temperature. If you overbrew it, it can become very bitter. If you underbrew it, it can become very bland. I want to talk about, using that as a metaphor, I want to talk about the risks. See, that is something which people usually shy away from talking about. Everybody talks about yield, everybody talks about that. And I want to start off with you, Ashish. One of the biggest questions we've encountered when we talk about private credit is, what happens when the cycle turns? Okay? We've seen that happen a few times. Every 7 or 8 years it happens. Defaults, liquidity squeezes. How do you build it into your product design to minimize the impact, keeping in mind that the cycle will turn one day? Because these are long close-ended products, right? 5, 6, 7. So it's quite possible that the cycle might turn during the tenure. So how would you do that, Ashish?
So the economic cycles impact both large corporates and mid corporates. More so the mid corporates. The entire or a bulk of the private credit space caters to the mid corporates. So obviously there would be business cycles. But one differentiating factor between, say, a public credit and a private credit would be a bilateral kind of a negotiation in a private credit. You are trying to solve a specific problem for the promoters or the company, and there is an alignment of interest. So the idea would be to keep the interest aligned and have promoter skin in the game in the transaction. These are more closely structured and more nuanced transactions where you will have securities, for instance, pledge of shares of the promoter. So his entire net worth sort of in the business is tied into the funding that he has availed through the private credit funding provider. So the alignment has to be right, and there would be cycles. As long as the alignments are right, the risks can be mitigated. The cycles do turn around, and as long as promoters are willing to walk that path with you, and you're solving a specific problem, we don't see risk emanating from business cycles significantly in the private credit space. So getting the structure right is one of the most critical aspects of this segment.
Interesting. Ritesh, having heard all of this, okay, one of the key things we hear when we talk to family offices is, at the end of the day, they feel that private credit is like a black box. You know a lot of things, yet you get this feeling that probably you don't know everything. It could be an overhang of how debt has been managed whenever there has been a default. But this is a sense I've got when I've spoken to families. Andar kya chal raha hai? That's usually something they don't know too much about, or that is what they think. How do you address these concerns?
So, I think, let's look at it from a slightly different perspective, right? So, let's say mutual fund NFO is launched. Okay. Broadly, all you know is what strategy is going to follow in terms of filtration of selection criteria, etc. And this is a sector where you will invest. You don't know the stocks. Similarly, private credit, when it is launched, or any private market, whether it be private equity, etc., you know broad strategies. So you really don't know kahan karne wala. So, but we don't call that a black box. We call this as a black box. So if you just peel the onion, go to the next stage as to what they really mean by saying black box. In a public market transaction, you invest. There are standard operating guidelines in terms of how the disclosures of portfolios are made. If you look at the portfolio, which is the transparency, the first part, right? Once you look at the portfolio, if you're not comfortable in the portfolio, that you can easily exit. There is liquidity available. You put in the order and you get your money back. When it comes to private markets, when you're entering, situation is same. From a transparency perspective, there are no set guidelines or rules in terms of how the disclosures are supposed to come. Now, assuming that the fund manager is good and or the platform is nice, you're getting regular disclosures. But still, in terms of liquidity, even if you're not comfortable with certain, so you have to stick to it. You can't get out. Right? So that's the difference between private and public. How do you address that in the private market? I think we can all talk about liquidity and secondary market being developed, but I think that's going to take some time. In the interim, I think the way family offices are looking at it is to have a dual approach where you do investment in the fund, and at the same time have the option to do a co-investment structures. So you put some amount there, you get co-investment opportunities. If you like the transaction, if you understand the transaction well, you put additional money or you stay away from it, right? So that's one way of addressing this issue. Within private markets also, you have private equity, venture capital, and private credit. Now, in a private equity or a venture capital kind of a structure, fund manager needs to get 3-4 out of 10 right. If you get 3-4 right, you hit it out of the park. I mean, you are able to give the promised return to the investor, even if 2-3 become like 0. In a private credit structure, you get to get 9 or 10 out of 10. You cannot, assume कि 3 out of, because your upside is, your best case scenario is that you get your principal and interest back. There is no upside there, right? So downside protections becomes very important. Selection of fund manager, the team credentials, corporate governance, risk framework, independence of the board. All these things are important in private markets, but in private credit it becomes even more important because of this. Because 3 out of 4 is one part and 10 out of 10 is other part. Which is where I think the role of the wealth manager comes in, and the kind of due diligence that one does before recommending some of these products to family offices. So I think if a family office on their own probably cannot do the extent of due diligence on some of these aspects as an institution can do, and that's I think how you try to mitigate that.
Thank you for detailing it out. I just made a few notes while you were talking. I think transparency is a word I picked up. So at IVCA, what we're trying to do a lot with the regulator is bring in a lot more transparency, put in benchmarks, put in some practices. And yeah, I think the point is taken that the more that you do it, I would also argue that we need to have a mutual fund sahi hai moment. A lot of AMCs have alternate products as their portfolio, so maybe some part of investor education can go there. But that's a very valid point you're mentioning. Nischal, he was talking about transparency and all of that, and it just made me think. You talk a lot to family offices, you talk a lot to high net worth individuals, and usually they talk a lot about the product. At some stage, do you ever feel that they are glossing over some structural fault line? You need to point it out to them saying that, boss, ye sab to theek hai, but this can also go wrong, or this is something which you should be mindful about. Is there something which you brought to the notice of people which has been appreciated by them?
Yeah, sure. So just before coming to that, to add to his point, you have to get 10 out of 10, right? So on that, see, end of the day, there are idiosyncratic risks everywhere, right? So as a portfolio manager, we have to make the portfolio more and more granular. And that's what we do. We try to restrict individual exposure to say 4 to 5% of the portfolio. So that's how we try and mitigate, because getting 20 out of 20, obviously there is always a risk, right? So how you mitigate that? Coming to this point, right? So often when the borrowers come to private credit market, the expectation is because we charge slightly higher than what say bank or HDFC does, right? Which means we'll do everything and anything, right? But that may not be true. The reason we exist and flourish is because we offer flexible solution, which traditional banking system is not able to offer, right? Having said that, not every fund fact sheet is the same, which we keep reiterating every time we speak to the family offices or the distributors, right? For example, there is a misconception that if there is a more familiar name in the fact sheet, right? Maybe slightly larger group, more familiar name, right? Which means that specific credit is stronger than the others, right? So it's a general perception, which may not be true. Often, you have to ask yourself a question: why a larger corporate group is borrowing from this segment of investors, right? Which means possibly the structure could be, as Ashish was pointing out, the structure could be completely back-ended. The group could be asset rich but cash flow poor, maybe. Maybe the exit is entirely linked to the equity event, right? Which means in a way an investor is taking equity view, right? So these are some of the questions, whether there is a collateral which is say slightly weak, or collateral may be there, but is enforceability as simple as say like any other trade? It may not be the case. So as a fund manager, we would try and answer some of these questions. If it is solving, then yes, otherwise it's a pass for us. Because for us, there are three pillars. One is issuer specific risks and the mitigators, industry, and thirdly, it is structure. So structure robustness has to be very, very important, which means governance, which means collateral enforceability, seniority, all of them.
Very good point. I also like the point about granularity. And since you're talking about numbers, 10 out of 10, 3 out of 4, it just took me back to days when I was not very strong in some subjects. So there always used to be 80-80, correct? And I think in a platform like Alternates, as a fund manager, if you know that things are going wrong, there is always a chance of extending it. More often than not, money does come back. At least in private credit is what I've seen. I'm yet to see a credit blow, fight about major credit blow up happening. But yes, I'm just knocking wood while we're saying the same. So you also mentioned about borrowers, Nischal, and I'd just like to take this question to Archana. You deal a lot with borrowers. And you have an expertise, if you will, in origination, in talking to people. What is the one red flag? Some part intuition, some part data driven, but what is the one red flag that if you detect it very early in a borrower's business model, you'll just back off? I'm just trying to run the whole course from investing right up to origination to tell the audience how much of effort goes in terms of running a product like this.
So, with so much activity going on, it's really important to, when to lean in and when to take a step back and wait, or, maybe sometimes walk away from the deal also, despite how attractive it might be. Some of the things, one thing that really has stood out, and we've also seen particularly while evaluating, there might be sector specific agendas that we may have. We may want to sort of underwrite, particularly in a sector, let's say climate, or but across what really comes out is, companies may have a very healthy top line. They might be generating revenues year on year and a very healthy EBITDA again, but that never turns into cash. So it's sort of weak operating cash flows, or your EBITDA that never converts into free cash flows, and sometimes you booked income, but you never that this money is never going to be recoverable. You dig deeper and you try and understand that these are potentially really aged receivables. So these are some of the things that they need a quick glance. You don't need to deep dive to sort of get this understanding. And like Nischal was also highlighting, enforceability of collateral is also very important, because in private credit, the collateral package, we try to have at least north of 1.2x or 1.3x, and then which means that how enforceable is it, or is it is the promoter doing a lot of cross collateralization across group companies? So that would show misalignment of interest between the companies and the promoter or the others. So that would these are small governance cracks that you slowly start chipping away at, and then eventually you decide not to go ahead with a full fledged due diligence. There are several like these, but I think these have sort of stood out. Specifically speaking about where everything looks good on paper, but sometimes you see that the financial discipline might not be present. And a very simple example for that is cash over your total assets. That if that number is less than 5%, you want to be deployed, you want your money to make more and more returns, and from that perspective, you're sort of trying to improve your ROE, return on your capital, but you end up not maintaining adequate liquidity, which might be required in such challenging times as well. So those are some of the things that we've seen, just broadly, and always keep an eye out for specifically.
I'm going to push you a little bit more because this is very important for the audience to know, and I'm going to ask you to dive into your intuitive ability. Has it ever happened to you that you've looked at a borrower and it has checked all the boxes? Okay, your left brain is saying everything okay, I don't mind, but your right brain is saying hold on. You walked away from the deal and then something went wrong, and what went wrong? Has something like this ever happened? If you don't mind sharing an anecdote, you don't need to name the company.
Yeah. No, this was more in the electric mobility space. I was in a due diligence speaking to the promoters, and we were sort of trying to understand how the company is specifically looking at their products, and they were in the middle of an equity infusion that was supposed to come, and they had good quality marquee investors on their cap table, so it also seemed great on paper. But I think what really sort of happened is when we were speaking to some of their dealers, right? We were trying to understand how much does their product sell. So those were things that from a market feedback perspective, we heard that while it might stack up, the wallet share might come up to 10-15% and it's still a reasonable number, but for the number of years you've still been in the market, and then how have you shown traction, how have you grown, and what do your dealers and your vendors have to say about you has a really big role to play. So that, and I think also the customers, right? People who are using your products, what do they have to say? So that kind of feedback is typically, it usually could be just a part of a checklist, but sometimes it's been really insightful also to sort of understand that, this is what the market is saying about your product, and therefore how do you know about your due diligence, and, then become much more sharper about whether their sales, how does the revenue trend move? Is that also reflecting in the numbers? If it hasn't so far, it definitely will in the future.
Very interesting. I must also tell the audience that there's one thing which we've not talked about here is the role of the IC. Am I right? The investment committee. For all the effort which goes into origination, structuring, building covenants, yields, 2 out of 10 deals go through an IC because they have their own very strong filters. For them, reputation is as important as regulation. So what you see at the end of the day in terms of the products which come in, the borrowers which come into private credit have gone through an extensive filter. Coming back to the analogy of coffee, we've talked about beans, we've talked about bitterness, now let's talk about blends. Okay? I'm just trying to do a sort of a sneak preview into the future. US has got strong, bold espressos, Europe has got smooth lattes. So what is the blend that we are trying to brew here in India? I'd just like to start off with you, Ritesh. We just agreed upon that private credit is becoming a mainstream allocation, but globally it is it's one of the fastest growing segments globally. Do you see Indian HNIs and family offices go down that path? Or do you think that for the next 3 or 4 or 5 years it will continue to be opportunistic?
Let me tell you, when it comes to money, whether it is family office, HNI or small investor, everybody is opportunistic. I don't think...
Sorry, it is what?
Everybody is opportunistic.
Wonderful.
So, even a small retail investor, एक housing loan में 25 basis points भी कम मिलेगा तो he will switch. So that is the reality that we are facing, and I don't think family office or HNI are any different. Ultimately, money is why we invest is to maximize our returns. Now, it can be in terms of investing where returns are going to be high, or if we feel markets are going to go down, then we keep money in fixed income so that we protect our downside. I think Indian investors are also no different. Wherever there is expectation that the equity valuations are high and probably they will not give very high returns, maybe low to mid teens, your fixed income allocation will go up, and so will the allocation to private credits. If tomorrow people feel gold is giving better returns, your real estate is going to give better returns, money will move. That's, I think, the ground reality, and I don't think we can change that. The fact remains that of the fixed income allocation, I think the allocation to private credit is going up, and that trend is unlikely to kind of change in my view, primarily because fixed income is still not likely to give double-digit return on a consistent basis. So whereas private credit is something which is kind of beating inflation. So yes, I think family offices are looking at private credit, but I think investing is always opportunistic from any investor's perspective.
I quite like the answer. I got caught off guard because I didn't expect that answer, but it's true. I think there is a bit of opportunism here, if you will. But I'm also equally seeing that we talked about HNIs and family offices, a lot of substitution is happening. There was this report which I talked about earlier, in which more and more individual investors and HNIs and family offices are shifting from, say, a physical asset class like real estate to AIFs, to invest in real estate. So I hope it remains opportunistic, but this proportion of opportunistic becomes more and more mainstream is what I think would eventually happen. But for that to happen, and Nischal, my next question is to you, it cannot be just wishful thinking. You cannot hope that it becomes mainstream. One of the reasons globally why private credit has scaled up, two of things. One is innovation and the other is structures. Okay? Do you think in the Indian private, or let me rephrase, what do you think in the Indian private credit market, in terms of innovations, in terms of structures, can lead to such a stupendous growth over the next 5 years?
Yeah, so one is structure and second is as an innovation and second is obviously small tweakings in the existing products, right? So just to say address his point that some of the investors are opportunistic, right? So what if, say, the investor is wanting to take the credit risk, but maybe he doesn't have a 5-year view, which is typically the ask for a Cat 2 fund, right? So there is this category globally, which is semi-liquids, which is huge, almost $100 billion AUM globally, right? Semi-liquid, we call it interval funds. So that is one segment where we think a lot of growth potential in India, because that is something which allows investor to deploy his funds quickly and also stay invested. Unlike a Cat 2 fund where deployment takes time and also there are distributions in between, which in the form of, say, interest income or in the form of principal repayment, right? Wherein the investor may not want interim liquidity. So this is one category which we think can grow really large, obviously with some sort of help from the regulator as well. For example, today this category is, it's a Cat 3 AI, right? If taxation for this is also as per Cat 2, which is passed through to the investors, then that would be a big boost in this category. And in India also it can grow tremendously. So that is one. Secondly, say today the minimum tenor for the fund would be, say, 3 years, right? That's a regulatory requirement, right? What if this tenor is shortened to, say, 1 year, 1.5 years? Then maybe altogether new set of investor class, say for example corporate treasuries. They could also find some space within this segment, right, which could be interest to them. There also could be maybe, for example, we were the first ones to, say, launch a Gift City based pure PTC focused fund. It attracts all the global funds. There is a leverage in that fund, which is what is making it very attractive for, say, investors like IFC, BII, right? So similarly, if some sort of leverage is also allowed in Cat 2 strategy, that could open up a big opportunity for some of these global investors. What if, say, AIF units are allowed to be listed and traded? That could be a confidence booster for the investors, right? There are also some categories or maybe segments which require large amount of capital, right? For example, climate, agri, it could be infra. So there is global interest. Whenever we interact with these global investors, there is a lot of interest in that segment. But those are very sophisticated investors and they require some sort of differential rights with respect to risk, returns, liquidity while being in the same portfolio. So if some sort of flexibility is allowed in the same setup, then possibly, obviously one has to have additional guardrails, say increased disclosures or higher minimum ticket size for someone to invest. But with that, there could be, at least we are of the view that there could be exponential growth in this sector.
Amazing. Right now, I think you've thrown out there tons of ideas. I think we keep discussing this behind closed doors, but now it's out there in the open for wonderful. In fact, talking about innovation, Archana, I think you started in your opening answer, you were talking about themes like sustainability and sustainability linked loans, energy transition, hybrid capital structures. We had the gentleman from Gift City coming in today and I think there's a lot of focus there as well. Which of these trends do you think are going to just take off in the next 5 years that most manufacturers should be mindful of?
Right, it's very interesting you should should ask this because we recently structured and invested in the first domestic green bond issued by a private company in the sustainable agriculture space. So these kind of bonds typically have step down and step up coupons related to achievement of their sustainability milestones. And I think it's becoming increasingly important to start investing in these outcome-linked models if we were to achieve our collective goals. Thematic private credit strategies are definitely going to be a trend, and IFC recently is investing a large amount of capital in HDFC's affordable housing fund. So similar themes, it could be across healthcare, and that could be around diagnostics or let's say medtech, telemedicine. So anything that would improve affordable access to healthcare, that could be a strategy. And hospital chains are looking at private credit with a maybe convertible option other than going for equity to sort of avoid that level of dilution. We have education and employment as core themes. So that also, upskilling, vocational training institutes, and potentially job tech platforms to improve employability. So these are thematic focus areas that potentially has a lot of opportunity, and just like consumption funds or climate focused funds, these could definitely sort of add value, and it's a very exciting time from that perspective to look at private credit.
Amazing. As I recollect the movie Terminator, there was a dialogue, the future is already here. We talk about 5 years, but you already started doing it here. Amazing. Ashish, one of the biggest triggers for the growth of any industry, we've seen that in several industries, more recently in ETFs, is attracting institutional capital, the big daddies in the business. Pensions, sovereign funds, insurers. They give the industry scale as well as stability, a lot of issues which we talked about just now. What do we need to do here? You could talk about regulation, you could talk about your wish list, in terms of getting structures in for these large pools of sticky capital to come into India. What is your view on that?
Sure. So there are 2-3 aspects here. One is the natural progression of the economy. So some of these investors that you were talking about are pretty large. Their deployable capital pools are pretty large. So India as an economy, as it grows, obviously there would be larger requirements specifically in a segment like private credit. But mainstream always in India would be banking. Private credit works together with the banking as a complementary product. So one should not expect the tail to wag the dog. So essentially one aspect is as the economy grows, you will have bigger opportunity sets. We are seeing a lot more promoters, second generations not interested, a lot of institutional capital coming in form of equity. The same thing would happen probably for debt also, where we'll see institutional capital coming in. And another important aspect is track records. So the private credit industry in India is pretty nascent. It would be say a decade and a half old, and we would have very limited number of funds which would have taken the money, deployed it, and exited fully all their investments. So that track record, once it gets created, that will establish the credibility of a market like India, and then it attracts the pension funds, the capital pools that you're talking about. So we are getting there. A few of the funds are doing great job in that aspect, and we expect a lot more capital to come in, both with the growth and progression of the economy, and as the track records get built out for this segment of the industry.
Very interesting. We've got hardly any time left, but I'm very tempted to just push this through, because every brew of coffee, a lot depends on the filter, right? And here the filter is the regulator. I want you to just tell me, this is a rapid fire question round, one question to each of you, depending on your expertise. There's still 1 minute left, I'm monitoring. Please don't play the music now. What is the one thing, Ashish, you would ask the regulator to do? From your point of view, for scale and trust, what is the one thing? Quickly.
Yeah, simply the capital market growth is very critical for India as a nation. So the idea should be bring in more mid-market companies to the capital market. A lot of people fear and they find it simpler to deal with banks and NBFC. We have to make it similarly easier for a lot of new corporates to come into the capital market, whatever regulatory ease in terms of disclosure, in terms of other challenges we can address, that will really help grow the market.
Wonderful. Ritesh, what do wealth managers need from the regulator to reassure clients?
I think standardization is something I think that is most important today. Like Nischal pointed out, you have performing credit, high yield credit, special situation, distressed. But performing credit, you have startup borrowers. So there is a lot of crossover. Like you have in mutual funds, where small cap, mid cap, large cap. I think that accounting wise, a lot of standardization need to happen. Some people are amortizing fees, some people are booking upfront, some people are zero coupon interest, accrual, cash. I think there's a lot of. So I think in portfolio disclosures again similar. So I think that level of clarity in investors definitely.
We literally have borrowed time, but Nischal, I'm going to push you through this. One change do you think the regulator needs to do to make structuring a little smoother?
Old but still relevant, tax parity between all the asset classes. Let everyone fight on the merits.
So continuum is catalyst. Okay, got it. Archana, what do origination-oriented people need from regulators? One thing quickly.
Yeah. So, given we spoke so much about bespoke capital solutions, I think more regulatory sandboxes to allow for innovative capital structures is definitely needed, and regular engagement, the fund managers and with the regulator, that would sort of allow and provide a lot of room for innovation.
So they say that too much of coffee can actually keep you awake at night. रात को आपको सोने नहीं देता coffee. And I think this discussion today on private credit should also keep you awake at night, but for the right reasons. Okay, thank you so much to my fellow panelists and the 4 master brewers that we have here. It's been a very invigorating session. Thank you so much.